Hello, everyone. Thank you so much for joining me. My name is Fawad Razaqzada, market analyst with Think Markets. I'm going to start the webinar now. So for those of you who are here, please let me know if you can hear me loud and clear. So in this room, I think my colleague Victor will be joining us later on from Sofia in Bulgaria. But today's webinar is obviously mostly about charts and technical analysis of major currency pairs and indices, as well as commodities. But we will also discuss very briefly like fundamentals as well. As this webinar is live, please help us by writing comments and questions in the chat window, and I'll be more than happy to provide analysis on any particular market that you are after. Before we proceed though, please read through the risk warning, and then we will look at some live charts. Okay, so these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So for those of you who are new to this webinar, it happens every week on Tuesdays at 11:30 London time. And really the agenda is very simple. We look at live charts and provide analysis on the back of what we see. So we don't normally prepare much for these webinars, so it's live. Please ask us questions and we'll try to cover anything you're interested in. We do have another webinar, by the way. I forgot to write it down here, which is on Friday of this week, which is on the non-farm payrolls report. The US non-farm payrolls report is on Friday, and so it's a preview for that jobs report. The time is again at 11:30, but on Friday, so in 4 days, 4 days time from now. So what's driving the markets then? Well, not a lot has changed over the last 4 weeks. Investors continue to favor stocks, especially those more sensitive to economic growth after the recent vaccine developments, which raised hopes that things will slowly go back to normal. We have been hearing positive vaccine updates every Monday in the past 4 weeks. And yesterday it was the US company Moderna, which added another 20% to its shares after it confirmed that application for an emergency use authorization for its COVID vaccine had been delivered to the FDA. So although stock markets wobbled a little bit on Monday to end the month of November on a downbeat note, it was still a record month with small caps doing particularly well, with the Russell 2000 index recording its best ever month. Bitcoin also surged, and the cryptocurrency has today hit a new record high as it tries to get to that $20,000 mark. I think it will get there. But gold and silver, they fell out of favor last month, although both metals have started this month on a positive note. And I'll cover those markets in a bit. But it's mostly the stock markets that have benefited from the vaccine developments, as well as commodity dollars like Norwegian krona, the New Zealand dollar, Australian dollar. These commodity dollars, also the Canadian dollar, they have risen along with underlying commodity prices like energy prices. Crude oil has been going up because of hopes that demand will recover in 2021. And there are hopes that this week the OPEC will delay its decision to hike output. They were planning to hike output a little bit, but they may delay that decision. And if they do that, then oil prices could increase further. So that's what's been driving the markets, really. And in terms of economic data, people have been more or less ignoring economic data because of the vaccine news and ongoing COVID and lockdowns and and whatnot. But we do have a few potentially moving market economic pointers, especially from the US economy this week, starting today with the ISM manufacturing PMI. The ISM services PMI is on Thursday, as well as jobless claims and that OPEC decision. Friday will be the big day for data in terms of jobs report from the US economy, as well as the Canadian economy jobs report will be released on Friday as well. In between, on Wednesday, we do have Aussie GDP as well as US ADP payrolls report. So there are a few things to look out for. But as I said, we don't tend to focus too much on the fundamentals in this webinar, as we focus primarily on the technical outlook on the major stock indices, FX, commodities, and so on. So I'm going to start off by looking at the German DAX index. This index, from the previous webinar, I don't know if you guys remembered, we highlighted this consolidation, bullish consolidation near the highs, suggesting that the bullish investors remained in control of price action, suggesting that if and when we break out of this triangle pattern, it will push to the upside. And so far, that's how it's proved. As you can see on the daily chart, we broke above the trend line, held there for a few days, and now it's starting to push higher towards its pre-lockdown highs. Post-lockdown highs that was hit in September. I think if we get there, then the next question is, can we hold above? If so, where do we head to next? And I think the next logical target for me would be the liquidity resting above the old record high, where trapped sellers stop loss orders might be resting at around 13,830. That's the kind of area I think the German DAX index is heading. Similarly, if you look at the FTSE, the FTSE has been inside this bullish consolidation on the daily time frame for a number of days now, after breaking sharply higher at the start of the month. So the bullish consolidation has allowed the RSI momentum indicator on the bottom of the screen to work off its overbought conditions through time rather than price action. So in other words, the index is no longer severely overbought from a momentum point of view, and that those overbought conditions have been worked off now. So momentum chasing traders will now look at the FTSE again and realize that it's no longer overbought, which means that they will most likely take advantage of the bullish trend and possibly increase buying pressure on the index again, which could then lead to a breakout above the June high of 6,515, potentially rising towards levels that we haven't seen since the early parts of this year. So if you draw some Fibonacci's on this chart, from the most recent significant high to the most significant low, I've deleted some of the retracement levels, but I'll add the 61.8% Fibonacci retracement there because we haven't tested that one, and that one just comes in just ahead of this high here. So that one comes in at 6,575. Those are some Fibonacci-based targets. Obviously, you'll have price action, past price action to work with as well. So an area such as these lows here could turn into potential resistance around the 7,000 mark, if and when the index gets there. But the first question is, can it get out of this bullish consolidation zone? And if it does, can it hold above it? I think yes to both questions. I think it's going to break out of this, hold above it, and push further higher. Similarly, we can see similar setups in other major indices. For example, if you look at the S&P 500 in the US, this one was in consolidation, still is in consolidation near the highs. But judging by yesterday's candle, when it printed a hammer-like candle or a doji-like candle, the index futures have pushed higher today, meaning that the index is likely to open near or possibly above the previous record high that was hit earlier this month. the Nasdaq 100, very similar picture. It's trying to, it's had a few tests of this level here, which was the record high. Tried to break through it here, failed here, it failed, but now it's kind of edging back towards that level, and the way it's moving up to it, strongly suggests to me that it wants to break through and push higher, which is not a major surprise really, given the type of month we had in November. So as a result of the ongoing risk-on rally in the equity markets, the safe haven dollar has been falling out of favor, especially against commodity dollars like the Australian, New Zealand dollars, Canadian, Norwegian krona. Those commodity dollars tend to perform well when expectations about the future of the economy improves. And so the dollar index has fallen out of favor because of that. But also the euro dollar has remained resilient as well. Most of the price action on the dollar index is determined by the euro dollar exchange rate more than anything else, because it comprises a large portion of the index. So the dollar index has been trending lower, and yesterday it broke below the September low. However, it held above it on a closing basis. So watch what happens here. If it breaks and holds below this level, then the downward pressure would remain intact. Otherwise, we could see some sort of a short squeeze rally on the dollar, potentially leading to a move back in this, within this range before it makes its next decision. So this black level is really important to watch, because it provides a reference point for traders to work off. If you look at the weekly, you can see that the dollar index has broken this long-term bullish trend line. So on this time frame, the path of least resistance is clearly to the downside, but that's not to say that it will continue to go down. As I said, this black level is really important. We need to go below that level for the downward trend to resume. I think it's kind of paused here a little bit. So for the trend to kind of accelerate, we need to see the dollar index break and hold below that level.
So it's the last
The next level down is probably
here.
90, a psychologically important level where the index had previously found some resistance back in April 2018 before it broke out. So that level is possibly a potential support to watch. This was the area of breakout right here at around 90.50. Below that, we have the 2018 low, which comes in at 88.25. So those are the downside targets. On this time frame, on this weekly time frame, we do need to see a break back above this broken bullish trend line to tilt the bias back in the bull's favor. So if it starts to recover from here and goes back and hold above the broken trend line, then that would be a bullish development. Longer term, we need to see a higher high. So the most recent high comes in right here. This high right here. We need to see the index break that high to objectively tell us that the long-term downtrend has ended. But in the short term, as I said, if it goes back above this broken bullish trend line, that would be bullish. But so for now, Fawad, I think the path of least resistance is clearly to the downside. A couple of questions here. Good morning to you, sir. Which time frame is best to follow? Monthly, weekly, daily? It really depends on the style of trader you are. For me, the most important is the daily. Because the daily provides you so much information that you won't necessarily see on the weekly or the monthly charts. Hold on, my colleague has just messaged me. 1 second, Victor. Hi, Victor. Are you there now?
Yes.
Yeah, sorry, I hadn't connected my headset.
All
Okay,
right.
guys, we have my colleague Victor in the room as well. So welcome, Victor. Just to
Yeah.
go, yeah, just to go back to the question, which time frame is best to follow? As I said, it really depends on the type of trader you are. For me, the daily is the best time frame to use because it gives you so many reference points to work with, and I don't know. I mean, the daily chart gives you about enough time frame as well to look at the past price action as well. Because when you zoom out too much to the weekly and the monthly charts, yes, you'll get like historical highs and lows and stuff, but those are historical levels, and people who had traded at around those levels, some of those people might have died by now, right? Some of them are no longer with us. That's why I don't really look at historical levels too much beyond the past year or 2 years. So that's why I think the daily is the best time frame. What do you reckon, Victor?
Generally, what I want to say on this matter is that the smaller the time frame a trader looks at, the more noise there is.
Sure.
And generally, if you start looking at the 5-minute charts or 1-minute charts, you're starting to race against the machines. And that's never a very optimistic scenario for a human.
Indeed.
The computer algorithms that are programmed to react to these smaller time frames are much more difficult to beat by you guys. So I would say that the longer the time frame that one starts to look at in order to take his trading decisions, the more constructive an analysis can be.
Yeah, I agree. I think one more point to add to this is that you can zoom into your 5 minutes, 15-minute time frames, so long as you have your levels based on higher time frame analysis. So if you got your levels from the daily or the weekly charts, then zooming into the 15-minute charts to look for precision in terms of entry or exits, then that's fine. But as Victor said, don't start off by looking at the 5 minutes without having the context of what's going on in the higher time frame. So, for example, we're looking at the dollar index here, you can clearly see that the trend is bearish. But if you looked at this on the 5-minute chart, which I'll bring it up now here, 5 minutes. Let's say you were looking at it in this particular day, and the dollar index was going up and up, and you bought it right here, thinking that, look, it's broken this high, it's gonna continue to push higher, so I'm gonna buy here, place my stop somewhere there and target there. What happens next is, well, it continues going up a little bit more before doing this. Boom, it drops. So have that high time frame analysis in mind whenever you zoom into your low time frames. Another question: what factors affect the dollar value? Lots of factors. Currently, it's all about risk on, risk off. So people are not really paying too much attention to economic data. Usually, it would be economic data that would impact a currency's value. But right now, people are focused on markets which are likely to benefit from the developments of the vaccine and the return to normalcy. So with that in mind, people are looking for bullish setups on commodity dollars, on commodities, on crude oil, on stocks, etc. And so they're not paying too much attention to the US dollar, because the US dollar is considered to be a safe haven currency. But if the market is feeling pessimistic about the future, then the dollar will likely find support for the same reason. But generally speaking, in normal times, what determines the value of a currency is expectations about future changes in interest rates. So generally speaking, if a country's central bank is raising interest rates, currency traders will favor that market because, by parking their funds into that country's banks, you will earn a higher rate of interest than a country which pays you lower interest, right? So generally speaking, any economy's central bank that's on a hiking cycle, usually that currency in normal times would be benefiting from flows into their savings into their banks and savings accounts. But right now, as I said, we are far from normal times, and things are very, very different right now. And interest rates are at or below zero in some cases across the major developed economies. So that's not, that's why people are not paying too much attention to short-term economic data anymore, because any monthly changes in data is not going to cause a major central bank like the Federal Reserve to hike interest rates. They'll want to see the trend of data improve, inflation to rise back to 2%, the employment situation to improve significantly, etc. So in normal circumstances, when the economy is doing well, then monthly data, which has an impact on expectations about interest rates, that will either positively or negatively impact the value of the currency in question. Anything else you'd like to add to that, Victor?
So I have a little bit to add, of course. So basically, what we're seeing right now with the value of the US dollar is the accelerating expectation that I'm not sure that this expectation is actually founded on solid ground, but the general expectation has been that a Democratic administration is less bullish for the dollar. Last time when in 2016 Donald Trump won, we had somewhat of a spike in the dollar, which lasted for about until about Donald Trump actually entered the presidency and started to govern. From there on out, the dollar actually weakened. And I don't rule out that we're generally seeing this negative kind of view of the dollar right now because of the new Democratic administration, which is supposedly more fiscally loose and allows for more money printing, more stimulus, and so on and so forth. However, I think that in the beginning of January, when we have the Senate re-elections in Georgia, where we get a confirmation that Democrats don't have Senate majority, this will play a refresher for the markets, and perhaps we are in for a decent dollar rally after these elections and after Joe Biden's administration actually starts to govern. There were some people who were very negative. We're talking negatively about the dollar, commenting that the appointment of Janet Yellen as Treasury Secretary is dollar negative. Well, Janet Yellen was the chairman of the Federal Reserve for several for 5 years, and the dollar has been actually rising while she was Fed chair. So I don't see why the dollar should be falling when she's Treasury Secretary.
Yeah, very interesting point. So obviously the elections, they are one of the many factors driving the value of the dollar lower. Right now, why it's falling is because these currencies have been going up. So if you go to Wikipedia, you'll see that the dollar index is made up of these currencies. The euro makes up 57% of the weight. Japanese yen, pound, also having an impact on a major impact on the dollar index. But generally speaking, it's the euro, and the euro has been rising because of. Hi, my daughter just woke up. Victor, can you provide some analysis on this while I put her back to sleep? Just give me 1 second.
Sure. So basically, the current euro rally, in my view, is mostly related to the relief related to the vaccine news that we might see better times ahead of us. I'm not so certain that we are actually going to see them happen as quickly as the market currently expects, because it's one thing to have a vaccine, and a totally different thing is to actually convince people to take the vaccine. Those of our listeners who are with us right now can think from themselves, like, are you willing to take this vaccine that has been developed in practically a year?
Yeah,
or less than a year, let's be frank here. So yeah, there is speculation that we are out of the woods.
yeah.
And my personal opinion is that we might not be out of the woods just yet. So this all risk currency rally,
Yeah,
and stock markets, etc., at some point could be revised.
exactly. Yeah, that's why it's important to watch price action very closely, as all major markets making new highs or testing key levels. Like, for example, the euro dollar is testing 120 handle, and it's very important to watch what happens here, because 120 has been historically very important, as you can see on this weekly time frame. But just to give you some potential scenarios for the euro dollar. Remember, in 2017 we had a very similar situation. Euro dollar rallied, consolidated, then it broke up on the upside before going down. So what we could see happen again is, we're seeing that bullish consolidation. We saw the ramp, now the consolidation, and we could see a potential breakout before the euro dollar goes down once again. Obviously, the ECB is meeting this month, and expectations are rife that they will increase QE, which should be negative for the euro in normal circumstances. But right now, more QE means it's positive for the risk-on trade for the stock markets. And when the stock markets go up, the dollar falls, right? So it kind of has a impact which you wouldn't normally expect. So it kind of does the opposite of what you normally expect. But that's how the markets are functioning right now. So that could be something that may actually push the euro dollar higher rather than lower if the ECB does increase QE, which supports the stock markets. But zooming into the lower time frames, the euro dollar has broken out of this bullish, this bull flag. We've held above the bull flag now. So it looks like it's very likely we'll take out the previous 2020 high. And what it does after that, who knows? But right now, the path will reach resistance looks to the upside. So I think a rally towards 121, 122 possibly is on the cards. However, it's important to be prepared in case the trends turn around. And for me, if the euro goes back below this level here at 117.45, then at that point I would drop my bullish view on the euro dollar exchange rate, because that level was the last low created before the latest breakout attempt. So should we go below that level, then it doesn't make sense for me to still be bullish on the euro dollar. The pound has lost his gains made earlier in the day. It was looking quite bullish earlier, but look at the shape of today's candle. It's kind of lost all of its gains. And the pound is actually, as Victor mentioned in last week's webinar, is testing this long-term bearish trend line. So you kind of got the feeling that investors are really waiting to see what happens regarding the Brexit talks, which are ongoing as time kind of runs out before the end. The deadline is before the end of this year for the EU and the UK to form some agreement on trade and whatnot. So I think people are still cautiously optimistic that we will see a deal, but we need to see that deal happen because time is running out fast. So
the breakout is not happening before we see the news, apparently.
Yeah, apparently that's what's happened. So watch out for the incoming headlines from the talks that are happening between the UK and EU representatives in the coming days and weeks. And if we start to see or hear positive news, then the pound could break out before it's officially announced. So watch out for that. And on the daily time frame, I've marked out a couple of levels to watch. The high of this year and the high of last year, they come in at around the 135 handle. So that's where I think the pound is most likely to head to in the event of a positive outcome from those talks. But if we break below the shaded region, then in the short term, that would be bearish in my view. Longer term, we have a couple of other levels, but we'll cross that bridge if and when we get there. I want to mention very quickly the Euro yen because of this. This is the weekly chart of the Euro yen. Here we have a possible breakout from a bullish flag pattern. See that? So the Euro yen rallied from its lows before reaching a temporary top here in August. Since then, price has been consolidating inside this bullish flag pattern, but now it's peaking above the high of the resistance trend of this flag pattern. And on the daily chart, it's looking quite interesting because here we have
a triple top.
A triple top. Now, the thing with triple tops is that yes, it looks like this level is really strong in terms of resistance. But what it also means is that a lot of people who sold here, they will have placed their stop loss orders above these highs, which can only mean one thing, right? That's where the market is going to go to next. That's what I think is going to happen for the Euro yen to break out, take out those stops, and then continue to push higher, possibly to this high here before making its next move. And on this time frame as well, we have a inverse head and shoulders as well. I don't need to draw it, but you can see that this is the head. Funny looking head. Shoulder here, another shoulder there. And that's the neckline. So I think the neckline is going to break. Also notice how bearish looking price candles continue to fail to bring out the sellers. Yesterday, for example, we formed this inverted hammer, no selling pressure whatsoever. Same picture on the euro dollar, by the way. If you look at the euro dollar,
same
price fell sharply
there yesterday. Yeah.
Big
visit of 120.
Yeah. So it looks like they are trapping the sellers into this before possibly ripping their faces with a big rally. And let's talk about commodities for a bit as well, because we have the OPEC meeting happening this week, and so far the price of Brent crude oil is going according to script. We wrote a report on it suggesting that it's gonna do something like this, and so far it's done something like that. It's taken out the previous highs, held above, and now it's consolidating above, consolidating near the recent highs. So this is a bullish consolidation. The longer it spends in, the longer it spends in consolidation near the highs, the more likely it will be that price will break higher. And the next level on the chart of Brent is at 50, which comes in just below the 61.8 Fibonacci retracement against this downswing. So the OPEC were meant to make a decision on oil output hike in January. They should have made that decision yesterday, but they couldn't make an agreement, and instead they gave the oil ministers extra time to think about the deal, to whether or not hike output or delay it further because of the renewed lockdowns hurting demand. So if they delay their decision to hike output, then that should be bullish for crude oil, and that could see Brent push to $50 later on in the week. So watch out for oil prices. Obviously, if they decide not to delay that decision, then there's a chance crude oil could fall. And if it does fall, watch out for potential support to come in at around 45. Gold has been looking interesting because obviously last month was one of its weakest months in the last several years. Okay, so last month it closed lower, but it's kind of bouncing back from this shaded area of potential support that we had highlighted previously. This area is important because it's kind of the area of where price had previously broken out from. So previously support is offering some support once again. But what is interesting this time is, or what's interesting again here is that price broke below the 200-day moving average for a couple of days, and now it's trying to go back above it. The last time it did that, it was in March, when it broke below the 200-day moving average, spent some time below it, trapping the sellers before ripping higher. Then the RSI was oversold. This is the RSI index, the relative strength index. The RSI was at 30 at that time.
As it is probably now.
As it is probably right now. Well, it was yesterday. So very similar picture to March. So what I am looking for now is for price to make a higher high. The most recent high comes in at 1815 or 1818. This was that high here. If we break through that high, then any short-term dips back to support could then be supported, leading to a potential rally. Now, the big area of resistance is this shaded region here, formerly support. So in the short term, I think that's the limit for gold. And we may very well see a strong reaction from there to the downside. But if and when we break through that area, then that would be really bullish, because it will suggest that the latest breakdown was all to trap sellers again before prices push higher. So key resistance area coming up in this shaded region. To get there, there are a couple of other levels to break. Most importantly, this 1818 level. If that level breaks, then short-term bias turns bullish, but longer term, it all depends on this shaded region. Silver is doing exactly what gold is.
Something similar.
Very similar, yeah. This level here, the August low, previously support, broke below it, went back above, held for a few days, then broke below. You can see what happened here. And then it finally broke down. It looked like it was going to take out this low. It didn't. Price rallied today, and it's now testing that resistance level. So it's very interesting to see what happens. A daily close above this shaded region would be bullish in my view. Longer term, it needs to take out this bearish trend line for the long-term trend to continue higher. Right, guys, I have run out of time, unfortunately. If you have any further questions, please ask now. And I can see that there are a couple of more comments that we haven't, or we probably haven't addressed yet. So it seems that QE is good for, good observation there regarding the euro dollar. Previously, I don't know when the previous decisions about QE was made. But generally speaking, yeah, QE hasn't stopped QE hasn't stopped the euro dollar to go higher. But will it be more successful this time? Who knows?
Yeah, it's we need to take into account here also what the Fed does at its upcoming meeting on December 16th. But first things first, we have the ECB on the 10th of December, and next week we're going to talk more about what we should be expecting into that meeting.
Yeah.
So in the meantime, stay tuned and stay careful.
Exactly. Yeah, especially if you're trading the euro dollar. And we'll talk more about the euro dollar in Friday's webinar, the non-farm payrolls preview webinar on Friday, which is happening at 11:30 London time. Make sure you join us for that one. And we will talk more about the euro dollar and other dollar crosses in that webinar. So then we have the same webinar that we had today next week on Tuesday. And then things will wind down as we head towards the year end because I think I'm going to be off in the last 2 weeks of the month. And then we obviously pick things up once again in January. But yeah, we should have at least a couple of more of these sort of webinars for the remainder of this month. So please make sure you join us. Take care, guys. It has been a pleasure, and we'll speak to you guys on Friday. Bye now.
Take care. Bye-bye.